Another question from pre-seen mock taxation June 25. What is the net value of the property that would have been included in calculating Adam's chargeable estate? What is the net property value? Okay. Adam died on 15 January 2025 and he had the following assets and liabilities at the time of his death. Properties 2,86,000 and examiner says note 1. There was an outstanding. Any question? Okay, that's great. There was an outstanding interest, only mortgage was 50,000. So basically from this property 286, we will deduct 50,000. So logically in the death estate, property value will be added, that is 236. So if there is any mortgage on the property, you will have to deduct that mortgage. So unless that mortgage is insured, otherwise you have to deduct the mortgage from the value of the property. So logically 2,36,000 will be added. Okay. Which of the following items from Adam's estate can be deducted in calculating death estate for IHT purposes? Actually, we deduct funeral expenses. We also deduct, I would say, legal debts. There's a credit card debt, of course, you have to deduct. Legal fees, note 2, let's see. There had been a verbal agreement to pay this off for his daughter. Actually, we don't take verbal agreement fees. We don't give verbal agreement exactly the same value which we give to a proper agreement. So legal fees which is coming just because of verbal agreement is not deductible. Otherwise, nobody is going to pay tax at all. Actually, it's very difficult. They promised, they made a verbal agreement. If HMRC, they start accepting the verbal agreement, then just think death estate will be just zero. Everyone will be putting so many things into that. So that is why HMRC says no. If there's any written agreement, if there's any proper legal agreement, then that fee will be deducted. Otherwise, verbal agreement things will not be deducted. So, which of the following items from Adam Estates is only credit card? That's it. Which two of the following statements Adam's death estate are true? Two, okay? None of his death estate will be taxable as under spousal exemption rule. Let's see. Has he left everything for the spouse? Okay. Under the terms of his will, Adam left his estate to his girlfriend. They never married. So girlfriend is not a spouse. Sorry. This is false. The property will be partially covered by the residence. No. Actually, the issue of residence nil band only arises when the deceased person has left the main residence for a direct descendants. Who comes in direct descendants? Children and grandchildren. Girlfriend does not come in direct descendants. So you will not be getting any residence nil band here. Residence nil band is only available when main residence in the death estate is left for direct descendants. Who comes in direct descendants? Children and grandchildren. Girlfriend is not coming in direct descendants. Sorry. The death estate will not deduct taper relief. True. Taper relief is actually available only on death tax, and it is again only available when donor dies at least after 3 years of making the gift. But taper relief is only available on death tax, not on death estate. The IHT liability on death estate will be calculated through IHT rate on death tax, IHT rate on death estate, both. It is 40%. So last two are true. Last two, they are true. By how much would the IHT liability on Adams death estate be reduced? They're asking how much IHT liability would be reduced. Had he died in 2032 instead of January 25? First, we need to understand the question. How much IST liability would be reduced if instead of January 25, he died on 2032? Let's read the question. Let's see. Okay, let's see. Under the will, everything was left to his girlfriend during his lifetime. On 18 December 24, Adam made a gift 46,000 to his brother. This gift is after deducting all available exemptions, means from this 46,000 annual exemption of the current year, previous year is already deducted. During the life, we know that during life it is PAT, but when donor dies within 7 years of the PAT becomes chargeable. So definitely, if Adam died on 15 January 25, logically this 46,000 becomes chargeable. Repeat. If Adam dies on 15 January 25, then logically this 46,000 becomes chargeable. Now the question, if it becomes chargeable, then what happens? If it becomes chargeable, then what happens? Let me explain that. Property value, we know that it is 286 minus the debt, which is 50,000. 236. I'm just calculating the chargeable estate. Shares, I'll take 1,22,000. I will deduct the credit card. That's it. Here comes the chargeable estate. 2,36,000 plus 122 minus 3,750. I'm getting 3,54,250. That is a chargeable estate. But directly on 3,54,250, you will not apply IST. I'll see the nil band. 3,25,000 less last 7 years gross chargeable transfer. When we are calculating IST on death estate, then we write prior to death. Prior to death. As I just mentioned, on the death of Adam, this 46,000, it becomes chargeable. So this 46,000 will utilize your nil band. If Adam is dead on January 25. So 3,25,000 minus 46. I'll get 2,79,000. So 354,250. Here comes the taxable amount, which is 75,250. On this taxable amount, I'll be paying 40% IST. IST at 40%. Let's take, this is 30,100. Now, instead of Adam died on January 25, examiner says if he died on 2032, then what happens? Then how much IST liability on death estate will reduce if he died on 2032? Now try to understand. The PAT was made 18 December 2024. Okay. If Adam is dead in 2032, then basically this PAT becomes fully exempt. Because potentially exempt transfer becomes exempt if donor is survive at least 7 years after making the PAT. So gift was made in 2024, Adam dies in 2032. It means the PAT becomes fully exempt. If PAT becomes fully exempt, then what happens? Logically, your chargeable estate will remain same, 3,54,250. Now, nil rate band is 325 minus last 7 years gross chargeable transfer prior to death. We don't have anything. Because 46,000 is not coming in the previous 7 years from the death. So entire 325 will be available. So your taxable amount will be 3,54,250 minus 325. Taxable amount is 29,250. taxable amount is 29,250. I'll take 40% of that, which is 11,700. So how much your IHT liability will be reduced? It is coming from 30,100 to 11,700. So 3,100 minus 11,700. There's a reduction in 18,400. There's a reduction of 18,400. This is what examiner was asking. How much your liability will reduce? There's a shortcut as well. The shortcut is previously 46,000 was there's what is a shortcut available, but sometimes students they get confused in the shortcut. The shortcut to solve the same question is if Adam died on January 25, then 46,000 will reduce your nil rate band. And obviously, when 46,000 is reducing your nil rate band, so technically you are getting lower nil rate band and you are paying more IHT liability. But if Adam dies on 2032, then 46,000 will not reduce your nil rate band. When 46,000 will not reduce your nil rate band, so you will be getting additional 46,000 nil rate band. Due to getting additional 46,000 nil rate band, you will be saving 40% tax. So simply 46,000 into 40%, 18,400. This is the shortcut. If Adam dies on January 25, then 46,000 will reduce your nil rate band. If Adam dies on 2032, then 46,000 will not reduce your nil rate band. Actually, you will be having more 46,000 of the nil rate band. So due to this, you will be saving 40% IHT liability. Otherwise, I have already, so the proper answer is here. First, we have calculated IHT on death estate. If Adam dies on January 25, what happens? How much you have to pay? Then another calculation was if Adam dies on 2032, how much IHT you will pay. Difference is the reduction in IHT. And the shortcut is there also. Now it is up to the student which one they want to actually follow. Okay. By what date should any inheritance tax due on death estate to be paid? Actually, IHT on death estate, IHT on death death is paid 6 months after the month of the death. 6 months after the month of the death. Here, he's died on January 25. So leave the January. Go 6 months ahead. 31st July 2025. So basically, IHT on death, state IHT on death tax is paid on 6 months after the month of the death. So that is 31st July 25. So students, that is all about another section B question from the pre-scene mock June 25. I'm going to conduct one more class on one more question of section B, and after that I'll be conducting one or maybe two classes for section C questions. The way back section A we have already done, you can see that. And if you recall, in our practice classes, almost every day we were doing 3 past paper questions. So thank you very much for watching this. We discuss the last question of section B, pre-scene mock, June 25, tax. Let's read the requirement. By what date does, just a minute, okay. By what date does the claim of for gift holder relief for the gift of shares, Feb 2024 means the tax year is 24-25, need to be made? Actually, the gift relief claim is made within 4 years from the end of the tax year in which the gift is made. If you're making the gift in the tax year 24-25, then you have to simply claim gift relief within 4 years from the end of the tax year. It means I'll go to 26, 27, 28, 29. So gift relief is made within 4 years from the end of the tax year in which the gift is made. So only you need to memorize the date, so the job is done. What is Bernie's CGT liability on the disposal of shares in Big Boots Limited on 8 March 25? So let's read the scenario. Angel gifted 25,000 £1 ordinary shares in Big Boots Limited, an unquoted trading company. When you are providing private companies shares as gift, so you will get gift relief, no matter whatever is your holding in that company. Bernice on 12 Feb 2025, when their market value was £10. Okay. Angel had subscribed for 25,000 shares in Big Boot Limited at par value on 1st August 2010. Angel gifted 25,000 £1 ordinary shares in Big Boot, an unconnected company, to her daughter Bernice. Basically, when the gift is provided, we always assume that deemed sale proceed is equal to market value. It means from Angel's perspective, donor is Angel. Deemed sale proceed will be the market value. So 25,000 into 10 is 2,50,000. Angels actually subscribe these shares. Subscribe means when an organization issued these shares first time, at that time Angel bought it. And Angel subscribed, obviously you subscribe for par value, and the par value is £1. Cost is 25,000. Your capital gain is 225. Entire gain is covered in the gift relief. Now the base cost for Dhoni, which is Bernice, base cost is the market value, which is 225, 250. From this 250, I will deduct the gift relief. Simply market value for the Dhoni less the gift relief. Here comes the base cost for Dhoni, which is 25,000. Okay, now what is happening? On 8 March 25, Bernice then sold 25,000 shares in Big Boot for 2,50,000 to an unconnected party. We need to calculate CGT payable for Bernice. Sale proceed is 250. Base cost 25. Capital gain is 225. Now we have to check the status of Bernice, plus we have to check annual exemption is available or already utilized. Big Boot other information. For the tax year 24-25, Angel and Bernice are both higher rate taxpayer. It means whatever the capital gain comes, you will be paying 20%. Unless the gain is on residential properties, then you will be paying 24%. Angel and Bernice are both higher rate taxpayer. They have each made other disposal of assets during the tax year 24-25, and therefore they both have already utilized their annual exempt amount. So no annual exempt amount is available directly. CGT rate is 20%. Because both are, Bernice is a higher rate taxpayer, annual exemption is already utilized. So 225, then 20%. I'm getting 45,000. So CGT payable is 45,000. It is mentioned in the question, Bernice has already utilized the annual exempt amount. Second, it is mentioned in the question, Bernice and Angel, especially right now we are focusing on Bernice, is a higher rate taxpayer. So there's no space in the basic rate band. That is why I did not go for 10%. Plus the capital gain is on other than the residential properties. That is why 24% is 20% is applicable. So CGT payable is 45,000. So we are not getting any annual exempt amount. The annual exempt amount of 3,000 is already utilized. So that is why we are just applying directly 20%. Now let's go ahead. Okay, if Angel herself had actually sold the shares in Big Boot to a third party and then gifted the cash proceed to Bernice, which of the following statement would have been true? Always remember under CGT, cash is exempt. Under CGT, cash is an exempt asset. Okay, let's see the scenario first. Big Boot. Big Boot Limited has a share capital 1 lakh ordinary share. Angel was the sales director of the company from its incorporation, August 10 until 12 Feb 2025. Bernice has never been an employee. Okay, now let's see. The scenario is if Angel had actually sold the shares to third party and cash was given as gift to Bernice. So which statement is true? I've already told you cash under CGT is exempt. Let's see. Business asset disposal would have been available on this. Yes, true. Because uh, there is simply a personal trading company for Angel. How? You can see the holding in this company is more than 5%. Personal trading company is a company where your holding is at least 5%. Total number of shares the company is having 1 lakh. Angel had got 25,000 shares, which makes the holding 25%. Second, ownership period prior to the disposal is 2 years, plus Angel is an employee of that organization. So you have been an employee of that company at least 2 years prior to the disposal, plus the ownership period is 2 years, at least prior to the disposal. In fact, it is more than that. So all the conditions of bidder are met. The CGT liability would have been paid later when gifted shares to Bernice. Both are selling on the same date, so how can there's no delay? False. The cash gift would have been cash gift is exempt. Cash gift would have qualified for. Actually, cash is an exempt asset under CGT. Which of the following statement about disposal of residential property by Bernice on 31st March 25 is true? Which of the following statements about the disposal of the residential property Bernice on March 25 is true? If she had delayed the disposal of the property until May 2025, actually May 2025 means the tax year is going to be 25-26. If she had delayed the disposal of the property, let's see what are they saying about the property. Okay. There's a residential property. Bernice disposed of a residential property on 31st March 25, which falls in the tax year 24-25, for a capital gain of 380. She legally owned this property herself and rented it out during her entire period of ownership. Bernice's husband, Kame, has no taxable income, has not disposed any asset during the tax year 24-25. Now come here. If she had delayed the disposal of the property, May 25 actually falls in the tax year 25. She would have saved the tax. The answer is true. Why? Basically, in the current tax year, which is 24-25, she has already utilized her annual exempt amount, which is mentioned in the question. Bernice has already used the capital annual exempt amount of 3,000 in the tax year 24-25. If she delays till May 25, so obviously May 25 falls in a next tax year 25-26, so annual exempt amount of 25-26 will be available, which will save the tax. The purchaser would need to pay CGT due within purchase. Why would the purchaser will pay? Seller has to pay CGT. Kame would have transferred his unused annual exemption amount to Bernice. You cannot annual exempt amount cannot be transferred. Sorry. Disposal of the property. Can I say disposal of the property? You are a higher taxpayer. It is subject to 24%. It's not subject to 20%. Only one is true. First one. How much capital gain tax would have been saved if Bernice has transferred 50% of ownership of the residential property to Kame prior to its disposal? That's a good question. Actually, total capital gain is 3,80,000. Now try to understand. And Kame, husband, does not have any income, no disposal at all. if Bernice transfer 50% of the property. Now try to understand. 380. So 50% will be with Bernice and Cam will get the 50%. Okay. Obviously, Bernice will have to pay 24%. 1,90,000, just take 24%. I'm getting 45,600. Cam will get annual exempt amount 3,000. 190 minus 3,000. 1,87,000. Now, basic rate band is available to Cam 37,700 into 18%. Okay, I'll do it. Don't worry. Let's take 37,700 and 18%. 6,786. 1,87,000. From 1,87,000, simply deduct 37,700. I'm getting 1,49,300, then 24%. We just want to see if 50% of the property before the disposal is transferred to the CAME, how much tax could be saved? How much CGT could be saved? 1,49,300, 24%. 35,832. 6,786 plus 35,832. Logically, if you transfer the 50% of the property before disposal to CAME, total CGT will be 45,600. Then I'll show you the shortcut as well. 45,600 plus 42,680. This will be your total CGT payable 88,218. If 50% of the property before the disposal is transferred to the CAME, total CGT payable will be this. Now, CGT payable without transferring 50% to CAME. If we are not transferring to CAME, so there's a capital gain of 380. Bernice has already utilized her annual exempt amount. Bernice is a higher rate taxpayer. So directly I'll apply 24% on this. So 91,200. If you're not transferring 50% of the property before the disposal to your husband, you will be paying total 91,200. If you transfer, you will be paying total 88,219. So how much CGT will be saved? 88. Let's see. 2,982 will be saved. Repeat what I did. I simply calculated the CG total. I just calculated the total CGT payable if 50% of the properties before the disposal is transferred to CAME. So this will be your total CGT payable. Then I have just compared this if we do not transfer the property to CAME. So what will be the CGT payable? So due to transfer, how much you will be saving? 2,982. I hope now it is clear. Please reply. Just the comparison, if you transfer 50% of the property before the disposal to your husband, what will be your total CGT payable? And if you do not transfer, what is your total CGT payable? Difference is the saving. So students, that is all about your section B of the pre-scene mock. We have done all the section A, the way back we have already done. And this was the last question of pre-scene mock section B. We have already done the previous two questions. And now the plan is tomorrow we'll be discussing section C, inshallah, of tax pre-scene June 25 mock. So thank you very much for attending today's class. I hope this is the last question. There shouldn't be any. Okay. So hope to see you all tomorrow as well. Thank you. Okay, dear students, in the previous class, we have discussed the entire section A of pre-seen ACCA mock, June 25. In today's class, we'll be discussing section B, question 1 of the section B. So the class will not be so long, don't worry at all. Let's read the scenario. Basically, what happens in section B, examiner gives you a small scenario. On that small scenario, examiner is going to ask you 5 multiple choice questions. This scenario relates to the question 16 to 20. Marvin owns a sole trade business making candles, a standard rated supply for VAT. Okay. Her VAT exclusive total turnover. Exclusive means without VAT. If examiner says inclusive means with VAT. Something which is VAT exclusive, that is 100%. If something which is VAT inclusive, then we say it has become 120%. VAT exclusive means without VAT. For the year ended March 25 was 1,06,200. Okay. The input and output VAT for the business for the most recent 2 years is as follows. Input VAT we reclaim from HMRC, output VAT we collect from the customer and we pay to HMRC. Logically, if your output VAT is more than input, difference is VAT payable to HMRC. If your input is more than output, then difference is VAT refundable from HMRC. Year ended March 24. You can see that March 24, you are having a VAT payable. Why? Because output is more than input. And the same is happening in March 25 as well. Your output VAT is more than input VAT. Okay. Morven has never used any special VAT scheme but is considering registering for either annual accounting scheme. Okay. Actually, if you go for annual accounting scheme, so the benefit is you will be just submitting one VAT return. But in an annual accounting scheme, you will have to make VAT payments in 9 equal installments. It starts from the 4th month. Basically, what happens, you have to take the VAT payable of previous year. Whatever the VAT payable is in the previous year, 10% of that you start making payments in the current year from month 4 onwards. So there will be 9 payment in accounts. There will be 9 payment on accounts if you go for annual accounting scheme. Or a flat rate scheme. Actually, in flat rate scheme, what happens? Number one, we calculate all of your supplies, we make them VAT inclusive. Means we add VAT into that, then multiply by the flat rate percentage, whatever it is. Then whatever the answer comes, that will be directly a VAT payable you have to pay to HMRC. In flat rate scheme, we don't do this. First calculate output, then minus input. No. In a flat rate scheme, we'll take all of your supplies and we will make them VAT inclusive. All means even I'll take your exempt supplies as well. I will take your zero rated supplies as well. All of your supplies. VAT rate is 20%, obviously. So you will make them VAT inclusive, then whatever value comes into flat rate percentage, and you have to pay that to HMRC. If she uses flat rate scheme in her business, so flat rate is 11%. Okay. Morven was late submitting the VAT return. Actually, every time when you are submitting a VAT return late, you are getting one, I would say, penalty point. You are not paying any penalty, but each time your return is late, you are getting a one penalty point. If it happens 4 times, then once your score of late payment reaches 4 penalty points, then that will be the first occasion where you will be paying a penalty of £200. And after that, subsequently on each return file submitted late, you will be paying a penalty of £200. Unless the next four return you submit on time, then your score becomes zero. Repeat. Each time when you are submitting a VAT return late, so you're getting one penalty point. Once the penalty point score reaches 4, means 4 returns you have submitted late, then this will be the first occasion you will be paying £200 penalty. And after that, any late submission of VAT return, you will be paying £200. But if subsequently, once you have reached the score 4, but if subsequently next 4 returns you submit on time, your score becomes 0. Morvin was late submitting the VAT return and making VAT payment for VAT quarter. Okay, Morvin was late submitting the VAT returns and making the VAT payment for VAT quarters ended 30th June X4, 30th June 2024, September 24, December 24, with her most recent VAT return and payment for the period ended March 25 being made 7 days late. If you count, so score has reached 4. How? June was late, 1. September was late, 2. December was late 3. And even the most recent is also late, 4. So once your penalty score is 4, you have to pay £200. And after that, on further any late submission of ad return, you will have to pay £200 unless your next 4 returns are submitted on time. Morvin issues VAT invoices for some of her supplies. Means you're not issuing invoices for all of your invoice supplies. So it is permissible. For example, if you are selling goods to a customer who is not VAT registered, repeat, if you're selling goods to a customer who is not VAT registered, in that case, it is permissible. In that case, it is permissible. You can do that. If you're not issuing supplies to them, it's okay. Repeat. Basically, if your customer is not registered, if your customer is not registered with the VAT authorities, then you can do that. You can issue, it's okay if you're not issuing VAT invoices to them. Simply if your person is not a taxable person, then you're not issuing the VAT invoices, that is acceptable. Now let's see the scenario what examiner is actually asking us. Which of the following statement is an advantage being the annual accounting scheme? Which of the following statement is an advantage being in the annual accounting scheme? Once in the scheme, there is never a requirement to the scheme. Once in the scheme, there is never a requirement to leave the scheme. Actually, there is a requirement. There's a certain condition when you can follow this annual accounting scheme and when you have to leave. So that this is false. There will be a fewer occasions when penalties could be triggered. That's true. Because in annual accounting scheme, what happens? We start making payments on accounts. So obviously then penalties occasion will be very few. There's no requirement to submit the VAT return false. You have to submit even once, but you have to. Taxpayer can choose any number, or you cannot choose any number of installment payments they wish. Actually, there's a requirement. You have to follow that. That is 9 monthly payments. Basically, you have to make number one, payments in advance, and those payments, they start from the fourth month. Those payments, they will start in fourth month. So you'll be making 9 installments. But if you want, you can go for less than that, but you cannot go more than that. So logically, taxpayer can, this is last one is also false. Taxpayer can choose any number of installments. You cannot choose any number. You can go for 9 or less than that. You cannot go more than that. So logically, B is the answer. Let's see. If Morven had decided to join the annual accounting scheme for the year ended 2024, what would be each of her monthly payment on account have been? Okay. Basically, we'll take output VAT minus input. Output minus input. I'm getting 7,700, 10% of that. Your payment on account is actually 10%. Output minus input, if there's a VAT payable, you will take 10% of that, which you have to pay in monthly installments on account. Okay. If Morven had registered for the flat scheme for the VAT year ended March 25, what would her VAT liability been? Okay, let's see. In a flat rate scheme, we have just discussed, we need VAT inclusive supplies multiplied by the flat rate percentage, which examiner gives you, and they have given you here 11%. Morven owns a sole trader business making candles, a standard rated supply for VAT. Her VAT exclusive total return is this. This is VAT exclusive, means without VAT. 1,06,200 plus we'll add VAT. 20% of this. 1,06,200. If I take 20% of this, it will becomes 21,240. So it will be, so VAT inclusive value is 1,27,440 multiplied by flat rate percentage, which is 11%. I'm getting 14,018.4. So first you have to calculate VAT inclusive supplies and then multiply by flat rate percentage. Which of the following statements about the implication of late VAT return submission payment for quarter ended March 25? True. Actually, they are already late 4 times. A penalty of 800 will be payable, no. A late filing penalty and late payment penalty will arise. Any further late return filed will incur £200 unless 12 months has passed without a late submission of the VAT return. Basically, third one is logical. When your score of penalty point reaches 4, number one, you have to pay £200. But after that, what happens? Any further late return filed will incur a penalty of £200. Unless if 12 months pass without a late return submission, then there will be no penalty. So logically, C is correct. Which two of the following statement about Morven issuing a VAT invoice are true? Morven has to include the name, address of the customer on the detail in, yes. When you are saying detail invoice, so you have to, Morven has to include name, address that is required for a detail invoice. Morven can issue less detailed invoice supplying totaling 250 before VAT. False. Actually, it is 250 including VAT, not 250 without VAT. Morven does not have to issue VAT to a customer who is not a taxable person. True. Morven can issue an electronic VAT if even if the customer does not agree. No, no. Actually, electronic VAT return can only be issued with the agreement, not without agreement. False. So logically, A and C. Okay, students, I just wanted to discuss this question. Now, listen. Actually, in this question, what examiner has tested the concept and the rule of flat rate scheme. Second, how do we pay, how much penalty we pay on late submission of VAT return. Then if I'm issuing a detailed invoice, what it should include. Plus when I'm not required to issue a VAT invoice. Another point which examiner has tested here was relating to, if you recall, this one we have discussed. Annual accounting scheme also. Annual accounting scheme also. Final question we'll discuss again. If you're issuing a VAT invoice with a detail, then Morven has to include the name and address of the customer on a detailed invoice. How can you say an invoice to be a detailed invoice if there's no name of the customer, there's no address of the customer? So you have to include that. You can issue a less detailed invoice if your supply amount is £250, but including VAT. Here, 250 is technically exclusive of VAT. So less detailed invoice can be issued for a supply inclusive of VAT. So why the second was incorrect? Because 250 you have written before VAT. Morven does not have to issue a VAT to a customer who is not a taxable person. Yes. So if someone is not a taxable person, so there's no need to issue VAT invoice. Electronic invoice can only be issued with the agreement of a customer. Electronic invoice can only be issued when there is an agreement of the customer. When your customer is agree for that, only then you can go for electronic invoice. Otherwise, you cannot issue the electronic invoice. Is this clear? Okay. So students, that is all about, I would say, this question. Let me pause the video.